Welcome to Inside Economics. I'm Mark Sandy, the chief economist of Moody's Analytics, and I'm joined by my trusty co-host, Ryan Sweet. Ryan, you've been trolling me again. I noticed on
the
Twitter.
highlight of my week, Mark. It's the highlight.
You know, I just can't keep up with you. I mean, this was a particularly biting troll. Is it trolling or trash talking? Did we figure that out?
I think we've settled on trolling.
We settled on trolling because trolling is social media. It's related to social media. Okay, that's what we. So this was the infamous. Well, you want to describe your troll?
I'm just trying to keep you in check.
Keep me in check.
We don't want your head getting too big on the stats game.
My head too big.
So, this one was the famous Bill Buckner play. And so in the 1986 World Series, the Red Sox are on the verge of winning their first World Series, and then the ball goes through the first baseman's legs.
Yeah. Were you born in 1986?
1980. So 6 years old.
So you don't remember that game? You didn't see it real time?
I didn't see it live.
Yeah, I remember that game very well. Actually, it was like, what just happened? Yeah,
it was unbelievable.
It was unbelievable.
So the first base coach for the Mets would eventually teach me how to hit baseball. So he gave me a signed Bill Buckner play. That was like the ultimate troll. So, before he went back to the majors, he signed it, gave it to me, and was like, put this on your wall. So I had that memory of Bill Buckner.
Did you have plans to go on to play Major League Baseball, professional baseball? Was that?
No, I was never that. I was not that good.
You were not that good, but
no,
you played for Washington and Lee, right? I mean,
Washington College.
Well, I'm sorry, Washington College. Yeah, Washington College. Yeah, very cool.
Mm-hmm.
And we have another guest, Claudia Sahm. How are you, Claudia? Good to have you on board. Thank you for joining us on Inside Economics.
Yep, good to be here.
Good, great to have you. And you are now this is your firm, Stay at Home Macro. That's the name, and that's a play on your last name, which I admit I did not get until you told me. I'm sorry about that. Yeah. And do you do a lot of consulting works, Claudia? Or what kind of consulting work do you do?
Yeah, I do a lot of policy work that is more of the pro bono type of work. And then I do a lot of talks on Federal Reserve, macro conditions for more of a Wall Street crowd. And I write a Substack now by the same name, Stay at Home Macro. And there I do a lot of both more technical Fed writing, but a lot of writing about inflation, the economy, fiscal policy to a more general audience to kind of pull back the curtain, make sure, we're all, it affects everybody. So that's a big, part of my work. And I do research too. So
yeah, perfect. Exactly who we need for this podcast, right? Because this is Jobs Friday. We've got the employment report for June. And you also, you got your chops at the Federal Reserve. You were at the Federal Reserve for quite some time.
Right. So I was at the Federal Reserve for over a decade. I worked on the staff's macro forecast. I worked in a group that oversees one of the household surveys that the Fed does, the low and moderate income families and communities. And during my time at the Fed, I also spent a year at the Council of Economic Advisors. So I've had a lot of opportunities to do policy work. And since I left the Fed, in 2019, I've had a chance to work with a lot of members of Congress on fiscal policy.
And who was CEA, Council of Economic Advisors chief at that time when you were there?
Jason Furman.
Oh, Jason. Oh, okay.
Yes, he was the chair. So I was right at the end of the Obama administration that last year.
Oh, yeah. Jason and I have been kind of going at it a little bit in, kind of an economist way around inflation and the causes of inflation. Can we come back to that?
Oh yeah, because I'm with you on that one.
Oh, you're on my side. Oh, then we're definitely coming back to this. Okay. Yep. All right. Demand versus supply, the bane of economists, is it demand or it's always boils down, is it demand or supply?
Yep.
Oh, and you're obviously famous for the Sahm Rule, but we're going to come back to that in the context of recessions and, what we should be looking at to gauge whether we are in recession, because that's a very prescient indicator that you came up with. But before we do all of that, let's come right back to the employment report for the month of June, which came out this morning, July 8th. And as we typically do, let's, Ryan, can I turn to you and can you give us a sense of that report?
Yeah, no problem. So overall, I think it was a solid report. It just wasn't good across the board like we've seen in past months. There's many more blemishes in this report than what we saw last month and the month before that. But overall, the economy added a net 372,000 jobs, better than what we anticipated or the consensus. Job growth was fairly broad based. There's big increases in leisure and hospitality, healthcare. So overall, we're still below where we were pre-pandemic, but that gap is closing pretty quickly. So we should close that completely in the next couple of months. So job growth remains solid, doesn't show any signs of recession concerns. But then the household survey, there was a lot of blemishes in that thing. So household employment fell. When you adjust it to make it an
So
apples to apples.
just to step back a little bit. So you've been
Yeah.
focused on the establishment survey of businesses, and that came in at 300. We saw
72.
job creation in the month of June of 370,000. And now you're saying, okay, let's look at the survey of households, the households.
Correct.
Okay.
I think it's roughly 60,000 households. So it's a much smaller sample, but household employment fell. But when you adjust household employment to be comparable to that 372,000 that surveyed businesses, it rose around a little bit more than 100,000 on net. So household
You
employment.
mean there's conceptual differences between
Correct.
these two surveys, and if you correct for that, you go from a decline to a small
increase.
of
Yep.
100K or so.
Yep. And then the unemployment rate was unchanged. Unrounded, it slipped a little bit. But I think I was more concerned about the labor force participation. That fell. And also, like, when you look across men versus women, men's dropped noticeably over the last several months. Prime age employment to population ratio, my favorite metric, dropped back below 80%. That's concerning. So I'm wondering if that's starting to show some signs of weakness in the labor market. So overall, nothing to be overly concerned about, but there are more blemishes in this report.
Huh. Okay. Is that your take on it, Claudia? Would you characterize it the same way?
So I think at this point, we've gotten so used to big numbers and low unemployment rates that we're kind of numb to the goodness, right? There were times in the recovery from the Great Recession, we would have been doing cartwheels down the street with this report, regardless of the blemishes, right? So, so big picture, I think we have, like, this recovery has been so fast and so full of jobs, right? The recovery from the 2001 recession and the Great Recession, these were the jobless recoveries. Like, it took years and years to get things back on track. That is a huge difference with like long-term consequences. So it's good. The other thing I'd say with participation, as soon as I started hearing the commentary, and truly, Ryan, you're not the only one like that was talking about the blemishes. I think back to Steve Braun, who's the macro forecast director at the Council of Economic Advisors. And whenever monthly data would come in and we get all excited about labor force, he's like, stop. He's like, that number, like, it bounces around. So I think that's where, we've had a trend of improvement. It's been very slow, right? That was a surprise how slow it's been. So it hasn't picked up. I don't think I'm particularly concerned about 1 month, but it would be real nice if it started to speed up, and we definitely didn't get that. So I think, but I agree, there's not, there are things you can point to in this report and be like, oh, that could have been better. But I mean, I was holding my breath for the payrolls and the unemployment rate. Oh, and I'd also say with the household survey, there are people who've really looked at it, and basically you should put almost no weight on household employment versus payroll. Like, if you kind of put them together as a signal of where things are going. But like, it's important to take in all the data, pay attention to it.
So you're saying when trying to weight the importance or the informational value of the payroll survey, the 370,000 gain versus the household survey, the decline, or on a payroll basis, small gain, you'd say don't put weight on the household survey, just like really focus on the payroll survey.
Yeah, really low weight.
I mean, you should put little weight on the employment, the first prints of the establishment survey as well. They're subject to bigger revisions. On net, we saw a downward revision of 74,000. And I think when we get the annual benchmark revisions,
can you just explain that, Brian? So you're saying in the previous, going back and looking at the payroll survey results from May and April, those gains, which were quite sizable, they're still sizable, but they were
they're still
revised
enormous,
down a
right?
little
There's-
bit.
Mhm.
Yeah.
Yep.
Yeah.
So employment gets revised 3 times, and then once a year they do an annual benchmark revision. And if you look at the response rate, so what's the percent of people that are responding to the household survey or the establishment survey? They've been pretty low. June was actually above average, but the last, since the beginning of the year, they've been really, really low. So I agree with Claudia's point. Like, we don't want to make too much out of 1 month, but the trend in the labor force is just moving sideways. And I think that's something that, that you can't argue against the trend.
I though on that I'll push back a little bit. I haven't had a chance to look at the June data, but through May, even though participation has slowly risen, only slowly, labor force growth has really picked up, right? I mean,
The level is just sideways.
no,
you
no,
got-
no. The year-over-year growth, as I recall, for May was over 2%.
Yeah,
As
but
I
the
recall.
year-over-year comparisons, you get these odd quirks because this
Okay.
recovery has been really, really fast, but it's had some ups and downs. So
Okay,
if you look at the level, and levels don't lie, it's moving sideways.
I like that. Levels don't lie. Okay, all right, very good. Okay, but it feels like we're nitpicking here a little bit,
Mhm.
right? Doesn't it? I mean, broadly speaking, the labor market's pretty good, right? We're pretty close to full employment. We can debate it. Unemployment's at 3.6. The employment to population ratio for prime age workers are around 80. That's kind of our benchmark for full employment. We're creating a lot of jobs, but then that's slowing, and that's a feature, not a bug, right? Because we are at full employment. We can't continue to create jobs at 300, 400K per month without going past full employment and exacerbating wage and price pressure. So we need it to slow. Labor force growth isn't quite where we want it, but it feels like it's, more or less steadily, slowly coming back. Pandemic is still playing a role, right? Is that fair to characterize
Yeah.
it that way?
Yeah, I'd agree. And I think the other thing is we know there's a lot of demand for workers still. The job openings relative to unemployed workers is hanging out right around 2, right? And at very like high levels. So there's, there are jobs to bring people back into. I mean, they get to decide if they want to come back or not. But this is a really strong labor market, and that's important as we try to cool off the economy. Like if you start from a position of strength, that makes it a lot. You're going to have to create a lot less hardship to get things cooled off some, because they're really hot right now.
Yeah, no, that makes a lot of sense to me. Two statistics that I often look at in the report you didn't mention, or we haven't talked about, is hours worked, and that was stable. So that's a good sign. If that hour started to tick down, that might suggest some further significant weakening in the labor market and job growth, but didn't see that in the report. And wage growth, that seemed to be pretty good as well. I mean, it's still a little on the hot side, compared to where you might want to see it long run, because it's not consistent with current rates of productivity growth, but it was up 0.3%, right, in the month. It's up 5% ish over the past year. So it feels like wage growth is kind of sort of going where you'd want it to see. Right, Ryan? Would you agree with that?
Yeah, I just don't put a lot of emphasis in average hourly earnings.
Yeah.
But yeah, you're right. I mean, if you look at the employment cost index, Atlanta Fed wage tracker, yeah, wage growth is going where we would want it to be.
Right. I mean, I don't either on average hourly earnings because it's affected by the mix of jobs, occupations, industries, but it's so consistent. It's 5%. And that's very consistent with everything else, right? I mean, it feels like everything is, all the wage measures seem to be coalescing. It's 5% growth, feels like to me. No? Okay. Claudia, would you agree with that characterization around wage growth as well? Or do you have a different take on that?
Yeah, I think that's one. Wage growth is really hard to piece out of the data, right? So I'm a little wary of like a pinpoint that it moderates some, like from its, and this to me, like across all of these data series where you're starting to see wage growth flatten out at a a pace that is above where they were before, like regardless of exactly what number it was. It's clear they're still elevated relative to before COVID, but they have moderated. And I think the wage growth is probably the only thing the Fed really looked at. I mean, they looked at everything, but the wage growth was probably the only piece of these payroll or the jobs report that the Fed could possibly react to, right? Because it fits into the inflation space. And they've told us it's like unconditional. We're not stopping until the inflation rates come down. So I think we're seeing it moderating, and that should ease the fears of a wage price spiral. Right. That was the big concern, is if they started stepping up or stayed at these really high levels. And that's not what we're seeing.
Right. And it feels like, and I know Ryan's done some work in this area, that the causality is inflation, high inflation, the jump in inflation we've seen over the last year is driving the increase in wage growth. It's not that the wage growth is driving the inflation. It doesn't feel like we've got into that kind of dreaded wage price spiral that, certainly the Fed would fear.
Yeah, we don't, I think there's a pretty strong disconnect between what's happening with wage growth and what's happening with inflation. There is some pass through between the two, but I mean, the wage growth, workers were in high demand. Low wage workers were able to get higher pay to like come back, and they were moving around in different jobs. So, I mean, that's, in my opinion, what's really drove the wage gains. But you'd have to have an inflationary mindset set in, where people are like, oh, inflation is going up, and so they get the wage increases, and there's really no evidence of that, like, inflationary mindset. And that's what you'd need to tie the two together, the price inflation and the wage growth.
Of course, the Fed, when they raised rates 75 basis points, 3/4 of a point the last meeting, they called out the University of Michigan sentiment or inflation expectations. What did you think of that move?
I was not happy about this.
Seemed a little odd. Yeah.
Well, okay. So on the one hand, and all these models well, like in the type of macroeconomic models that are central to monetary policy, inflation expectations are absolutely crucial. Like, you can have them shift like 0.3 of a percentage point and people totally change their behavior. Right. And so, and then it like starts to spiral off this anchoring. And we really don't have a good sense of how these expectations are formed. And frankly, the measurement, that particular data series, I've done a lot of research on the Michigan survey, largely with fiscal policy. One time, I had the opportunity to sit and listen to the tapes because we were trying to figure out, some problems in our section on the stimulus checks. I listened to the tapes, and the section that just blew me away is when people were trying to answer these questions. By what percent do you think prices will increase in the next year? And it was so clear that a lot of people really struggle with percents. They're like, what do you mean prices? Do you mean gas? Do you mean, right? Like, so this is a question that I do think has information. But like the tenths, they were reacting to a 0.3 increase in a preliminary reading, which isn't even representative of the US population. Like, you got to have the full survey. And so there were like basically 300 people selected, but not representative, because it's not the full thing. And a little like probably the hardest question in this whole survey was one of the reasons that we kicked from 50 to 75 basis points.
Yeah.
I was just, but CPI was really bad. So like they could have, if they just said the CPI, I would have like
Consumer Price Index.
I would have been calm. But as soon as they brought that in and then it revised.
Oh, is this your non-calm state, or am I looking at your?
I don't know. It's hard to tell anymore.
Okay.
I will.
When you're mad, do you get really mad? It doesn't seem to me.
Yeah,
that's likely. Yeah.
Oh.
Oh, really? Okay.
So,
I haven't seen it then. Okay.
No, I internalized the macro data. Like this is just the way I am. It is a professional hazard as a forecaster, but it's been really rough.
Ryan does that too. I don't know. The listener doesn't know this, but if the number comes in off compared to his expectation, he cries like a baby. Just cries like a baby.
I don't know about that, but
I had to calm him down.
It affects me.
Yeah. Well, I mean,
That's
they're
called a trash talk because it's
Yeah,
There you
not
go.
on social media. That's trash talk.
yeah. I mean, there are people under the numbers, right? And a
Right.
lot of
Yeah,
times the
true.
macroeconomic discourse,
Yeah.
we make them sound like widgets. I mean, the idea that wage growth moderating is a
Yeah, I
good
know.
thing.
But it's
That's
weird.
yeah,
It's weird to say. I choke every time I say it. It's like, that is weird.
yeah.
Yeah, so weird. Hey, I've got a couple of other questions
Mhm.
around the jobs numbers. I'm just curious your perspective. One is we're creating a lot of jobs. We were at 500,000 per month for a while. Now we're down to say, okay, let's say we're at 350 to 400. That's still a lot of jobs. Is that consistent with a full employment economy? How can we be at full employment if we're creating that many jobs? How do you reconcile those things?
Yeah, it's as with every aspect of the economy, the labor market is very tough. Like we had such a massive drop in the labor force participation. I mean, people just walked away from jobs, right? So even and they haven't come back, as we were talking about. This very slow progress. That means that the unemployment rate, like, what does that mean? Like now we're at an unemployment rate very close to where we were before the pandemic, but we've lost all of these people who, and it's clear it's not just age. I mean, it was so abrupt. And so what is that unemployment rate telling us? Like, is this, I mean, because it could be telling us the labor market's even tighter, right? If these people would come back, or it could be if they come back and it's unemployed. So it's how do we really interpret that? Um, and the question, and this has come up in multiple recoveries, it's more extreme right now, is whether you write those people off, or not. Like after the Great Recession, there was a belief around 2015 that we were at full employment
Yeah.
because the labor force had been dropping and they're not coming back. And it turned out that a strong enough economy, that we
Found
had
out.
years down the road, they did come back.
Yeah.
Right. So that's part of why it's really hard to judge. And we're still, in terms of jobs, we still haven't made up the pre-pandemic levels. Now, one thing, something that I look in the report, and this isn't just showed up today, is if you look at the full-time jobs, they are back to pre-pandemic.
Mhm.
What's missing are these part-time jobs. And frankly, we talk about numbers, but there's an aspect of job quality that is really important. And there are groups of workers, particularly at the bottom, who have had to some extent more of an upper hand, right? And so they've been able to be choosier. And frankly, a lot of those part-time jobs, they're just bad jobs,
Mhm.
Mhm.
right? So I don't know. There's a lot going on in the
Mhm.
labor market, and
Mhm.
more than we would have in a regular recovery. Like it's just
Hey, I've got one more question for Ryan around the report, and I just before I ask it, just want to say that we're going to play the statistics game, and it seems like you're on board with the statistics game, right? Where we each come forward with a number, and the rest of us try to figure that
Yep.
out.
Mhm.
Okay. And I say this before I ask the question, Ryan, because I don't want to take anyone's statistic, and if I am, then stop me. But the question is, what about the pandemic? Do you see any effects of the pandemic still in the data in the report? Did you notice any of that in the numbers?
Yeah, that's one thing. One of the first things I looked at this morning, because if you look at the number of COVID cases, they increased between the May and June payroll reference week, which includes the week of the 12th. But the number of people that were out of work because of own illness, it didn't jump.
It did not.
No.
Okay.
So, because I think quarantine rules have changed, it's down to, I forget what it is now, 5 days versus 10 before. So the odds of people not working at least 1 hour during the reference period is much lower now. So I don't think the pandemic's really causing any big effects on the employment data. One thing I also looked at was the number of, getting back to the idea of, or should we forget about these people? There's 700,000 more people today that are not in the labor force, but want a job versus pre-pandemic. So those people are going to come back. It's, they're out because of childcare issues or family responsibilities or own illness. So I think as the pandemic continues to wind down, I think one encouraging thing was daycare worker employment at daycares increased more than 10,000. We need further improvement. We need more workers to go back and work at the daycare centers that should be able to pull more women back into the labor force.
Maybe I didn't read this right, but did I read in the report that there are roughly 600,000 people that said that they weren't looking for work because of the COVID, because of pandemic? Did I read that right?
I didn't see that.
You didn't see that? Okay.
No, but it doesn't mean it wasn't there.
Yeah. I don't know where I got
But
that.
I don't know how that number compares to what it was in January of this year.
Yeah, no, it's just very consistent with the number you said for folks that are out of the workforce that say they want a job. It's about 700K higher than it was pre-pandemic. That could be pandemic related.
Yes. No, I think a lot of it's pandemic related because it's in childcare, family responsibilities, own illness.
Right. Okay. Let's play the statistics game. I know people who are regular listeners get annoyed at me repeating this, but there are people out there who have never listened to this before. The game is we each come up with a statistic. The rest of us try to figure that out through guesswork, questioning, deductive reasoning. We want a statistic that's not so easy. It's a slam dunk. We all get it, but not too hard that, we'll never get it. And you get a bonus if it's something related to the topic at hand, labor market, or a statistic that came out recently. So with that, Claudia, I'm gonna let you off the hook first, so you can see how this is done. And Ryan is quite good at this. And by the way, we're missing our other co-host. I didn't bring up Chris. We see how fast we forgot about him, Ryan.
I know. Wasn't gonna say anything, but I assume he's on.
Well, he's still in that wine cellar somewhere.
That's what I was going to say.
Now he's in South Italy. He was in North Italy, then Central Italy. I'm sure he's in Sicily somewhere eating a grape or something. I don't know.
You see his dedication. We take the back seat to Italy.
I know, but Claudia, anytime Ryan goes away on vacation, I never go on vacation, by the way. But if Ryan goes on vacation, I'm just saying, if Ryan goes on vacation, he takes his microphone with him. But Chris, we don't know what we're not sure about Chris. It's all those crypto winnings. He cashed out. He's getting lazy. But anyway, where was I? Oh, the game. Ryan, what's the statistic?
I swear, you repeat the rules of the game just to remind yourself, because you break them all the time.
It's taken me a year to get that down roughly right.
Yeah, exactly. I'll give you three numbers: 6.4%, 1.2%, and 11.9%. They're all related. And they were all in the employment report.
Oh, they were all in the report. I was going to ask in the employment report. So repeat them one more time. 6.4,
1.2, and 11.9.
And these are percentages.
I'll even give you their year-over-year percent changes.
Are they? Are you looking at industries? The employment growth across industries?
They are industries.
Okay. And this is year-over-year growth.
It is.
So which industry has seen employment grow by 6.4% over the past year? Is the question.
It's not employment.
Oh, it's not employment. Oh. Oh, what? Well, geez, by industry.
Is it hours?
It is not hours. That'd been a good one, though.
Wages.
It's wages. So I'm kind of going against my trash.
Yeah, I was going to say, I didn't think you liked average hourly earnings.
Yeah.
This just stood out to me. So.
Okay, so 6.4. That's got to be what industry is kind of in the middle of the pack. I'd say, well, leisure hospitality's got to be the high one, right?
Very good. Yeah, 11.9. Yeah.
The low one, that's probably.
If you get this one.
Is it retail?
No.
Is it manufacturing?
It is not. You're just going to go down all the NAICS codes until you hit it.
Professional services.
Let me. No, that's not.
Maybe financial services.
Professional services 6.8.
Oh, 6.8. Well, so 6.4 is healthcare.
No.
Oh, I know. It's 1 point. It can't be government is 1.1.
No, it's not 1.2. So the 6.4, I'll still let you struggle. With
go ahead.
The 6.4 is total private non-supervisory average earnings. 6.4.
Okay. Oh, so so overall, the top line wage numbers, I believe 5.1 year over year.
Correct. Yep.
And that's across all workers,
Right. This is looking at just non-supervisory workers.
non-supervisory
Yeah.
workers. Okay.
All right. So what's 1.2?
We tried everything. Mining,
Mhm.
you know,
Information.
oh, I should have known. Yeah, information, which is kind of a hodgepodge of things, right?
It is. Yeah.
Yeah.
But it just shows you like 1.2 to 11.9, just the distribution of wage growth.
Right.
Gaps
Claudia,
and
just
norms.
for your information, that was a, you know, a pretty poor statistic. I'm just saying, you know.
Yeah. Well, the 6.4 wasn't an industry.
Oh, see,
See,
now
you
she's
tricked
trash
us.
talking.
See, there we go. Now you're gonna
She's
nitpick
already,
there.
she's into it now too.
See, this is what happens. Did Zandy call you last night?
No.
You guys are in cahoots.
No.
All right. Okay. Very good. Claudia, you want to go next?
Okay, mine is 2.8%.
And
Is this an
that-
unemployment rate?
Think it's not necessarily one from today.
Ooh.
So
So
it's a
what did you say,
pers-
Ryan? I missed what you said.
Oh, I asked if it was one of, because I was thinking demographic unemployment rates or education.
Oh, I see. One of the unemployment rates.
Are we
Yeah.
going to the JOLTS report?
No,
See,
she's
look at that
smiling.
smirk. Look at that smirk.
Yeah. Yeah. 2.8%.
2.8.
That can't be, um, it can't be quits, right? Because maybe quits are, I keep it level. I think of levels. So
Yeah.
four.
No,
million-
it's quits.
Oh, it is
Okay,
quits.
yeah.
Okay.
Yeah.
It is quits.
So it's back to my theme of better job quality, right? Like it
Mhm.
has it's down from November, December, but it was flat, and it is like notably higher than before COVID. And COVID
Right.
was a really good labor market. So all right, so I picked too easy of a one.
No, that's
No,
okay.
it's-
No,
it
no,
was
no,
a good
no.
one.
We'll
I
have
was
you
actually-
back. You know, you know, we'll have many cracks at this or bites at this apple. But you know, quits are that's the Great Resignation. So I kind of think of it in levels. So there's anything over 4 million people quitting a job in a month, and that's what we've been getting pretty consistently here. That's a lot of people leaving their job, and that remained the case in May. The last, or no, was it May? Yeah, May, the last data point that we have.
Yeah, and we can see they're going to other jobs. Like
Mhm.
that was kind of my problem with the framing of Great Resignation. It sounded like people were throwing in the towel
Yeah, good point.
and going home to sit on the couch, you know. But
Yeah, good
anyways,
point. Good.
okay.
I use quits. I use the quits rate when clients say, like, kind of push back saying that we're already in a recession. I was like, you can't be in a recession when people are quitting their jobs at this rate. Like it's just unheard of.
Well, I mean, do you get a lot of pushback from clients? Are a lot of people saying we're in recession?
Mhm. They want
Oh.
to know why recession isn't our baseline, because a lot of them
Oh.
pointing to the survey of economists that said 70% of economists said the economy will be in a recession by first half of next year.
First half
when
of 23.
Yeah, but when you look at the questions, it was if a recession was to occur, when would the timing be? It wasn't 70% of
see.
economists saying we're in a recession. We're going to
I
be.
see. So this is actually a good time to ask before I give you my statistic. Is to you, Claudia, to this debate. I guess it's a debate. I don't know why it's a debate, but I guess it is a debate. Are we already in recession? I mean, I guess it's a debate because GDP fell in the first quarter, and it looks like it's tracking, given the monthly data, it's going to fall again in the second quarter. So the rule of thumb is, it's just a rule of thumb, but the rule of thumb is 2 consecutive quarters of negative GDP is a recession. So the question, Claudia, are we in recession?
No.
Okay.
All right.
I mean, if a recession with strong job growth,
Yeah.
And the GDP, and we can talk a lot about recession, it's inventories and net
Mhm.
exports. I mean, the NBR doesn't even have GDP in its set of indicators it looks at for recession for this very reason. The only one that's in there is consumer spending, and that looked great in the first quarter. Right. You can't have this kind of job gains and unemployment and be in a recession. That's just
not consistent. And of course, people should know that at least in the US, we've all kind of coalesced around the Business Cycle Dating Committee, a group of academics at the National Bureau of Economic Research. They sit down and they look at a range of data, and they define a downturn, and I'm paraphrasing, as a broad-based persistent decline in economic activity. So if one indicator is down GDP, that doesn't necessarily mean you're in recession. In
Right.
fact, this doesn't feel like we're even close to recession, in the current.
Yeah, well, and inventories aren't economic activity,
Yeah.
right? Like that was a big part of GDP declining. But yeah, it's been a weird conversation. Like people are cheering on a recession or something.
Talking ourselves into one.
Yeah, but people are still spending and businesses are still hiring. So it's like, don't care what
Yeah.
you call this. I just want people to keep their jobs.
Well, maybe this is a good place for you to tell us about the Sam's Rule, which is, the regularity that you uncovered and is I'm going to mispronounce this. Eponymous? Is it eponymous? That where
Oh,
you know what I'm
yeah,
saying?
I'll butcher it too. Yeah, it ended up getting named after me.
Yeah, well, that's
Yeah,
great. I
yeah,
always wanted a Zandy something, but I've never had anything like this. So that's wonderful.
yeah.
So explain to
So
folks what that is.
right. So I was working on a proposal to send out checks automatically, stimulus checks in a recession. Like that was the whole point. It was a volume that Hamilton Project did about all the ways that we could put the types of things we do in recessions on autopilot. Tie them to economic conditions, get the politics out, figure them out ahead of time, and just hit go when a recession happens. Okay, so as part of the proposal, I've got to have something to say, when do we hit go? And I figured if you're going to send out hundreds of billions of dollars, it would be a good idea for this thing to be accurate. The government would mind, maybe not people, get some extra money. And so I knew, I mean, the unemployment is why we hate recessions, why we fight them, right? Like people, millions and millions of people losing jobs. That's the problem with a recession. Every recession has an increase in the unemployment rate. That's just like a feature of recessions. But unemployment very slowly increases. So what I spent a lot of time, many weekends, looking at patterns of changes in the unemployment rate.
See
And
that, Ryan? She snuck in that on weekends. Did you notice that?
I did notice that.
I'm a
Yeah.
hardworking economist.
Yeah, well, I was managing a team at the Fed. I had no time during the week. So like what, and mine is an indicator, right? It says we are in the first few months of a recession. It's not a forecast. Like people use changes in the unemployment rate as a forecasting tool, but this is
Right.
about we're in one. And it's really simple. You take the 3-month moving average of the unemployment rate, as we talked today. Don't get excited about monthly wiggles. So you take the 3 months moving average, you compare the current value to the lowest value over the prior 12 months. If that difference is a 0.5 percentage point or more, which is small, like a 0.5 percentage point isn't that much, then we are in a recession. Somewhere it is like there are no false positives. It is triggered in every single recession since the 1970s. It's highly accurate going all the way back to World War II. There's a couple times where it turns on before a recession. But yeah, and right now, the Sahm Rule, after we saw unemployment today, is 0.
Yeah.
So
no sign.
No sign. But things can, there's a difference between saying we're not in a recession, and I feel confident about that, and we aren't going into one.
Right.
Like those are two very separate, but I've been really surprised at how firmly people have latched on to this idea everywhere from, people like Danny Blanchflower, who's an economist. We had a lot of back and forth on this, all the way to Cardi B. I mean, like it's, really spanned the set here. So,
who's Cardi B?
She's a singer, like a pop star.
Oh no, he's
no, I have no idea who Cardi
How
B
can
is.
I know who that is and you don't?
You do not know who that is.
Are you kidding?
He just discovered Guns N' Roses in the last year.
Well, that's true. That's true, and they're pretty good, actually. Yeah. Yeah,
I got 3 little kids. I'm not listening to popular music. I'm listening to Wiggles.
Frank Sinatra. Okay. Yeah. Well, it's just good. He's good too, though. I have to say. Well, yeah, that's so right now. If I've been mispronouncing your last name, I would call you Sahm.
Sahm.
Sahm. Okay. Yeah. I've been Sam. I've been saying Sam.
It's okay.
I'm dyslexic. Not really. It's not really okay. But thank you for letting me off the hook. Sam, I apologize for that. Is saying no, this is not a recession, not even close, at least at this point. Yeah, right. Okay. Yeah, very good. Okay, let me give you my statistic. Ready?
Mhm.
Negative 1.6 and positive 1.8. Two numbers related,
From the employment report?
not from the employment report.
Okay. Did it come out this
Related
week?
to jobs.
It is not. No, it's not related to jobs. I was going to say directly related, but that would
See,
be
there you go. He
gaslighting.
violates one of the rules.
No. Come on. This is you'll appreciate this when you hear it. Or
Is
if you
it
don't get it.
financial market related?
Not financial market related. Down 1.6, up 1.8.
Well, wholesale inventories were up 1.8.
Oh, you're really digging. I wouldn't go down that rabbit hole. Wholesale inventories. Jeez
Never know. We were talking about
Is
inventory.
it-
Yeah, that would be rude for me to do that. Wholesale inventory. The inventories of canned beans or something. I wouldn't do that to you.
Is it US related?
It is U.S. related.
Okay.
Do you want a hint? I might give it away.
Is it trade related?
Not trade,
Okay.
although it includes trade. That's a big hint. Maybe not. Maybe that.
Not
Maybe
monthly GDP.
not monthly GDP.
Quarterly? Wait,
Down 1.6. What was down 1.6?
Oh, first quarter
Oh,
GDP.
The first quarter GDP.
we're going to
Oh my
third
gosh, that
revision?
like you guys, come on.
Wait, when was that released? That was last Thursday.
Yeah, last Thursday. Okay.
Wait, today is
It's
Friday.
relevant. Yeah. But here's okay. Now the
This is
one
what I have to
what's-
deal with.
1.8.
So-
What's the 1.8? This is important.
That's
This is
private.
important.
That's when you
Is
strip
it-
out inventories and trade.
Is it the PDFP? The
Uh,
consumption and business investment?
No.
No.
All right, you guys are hoping.
Private domestic sales?
GDI, gross
GDI.
domestic.
I should've known.
Yeah, GDI.
Yeah.
Which really the average of the two after revisions is a much better signal.
Mhm.
But I mean, it'll take a while to get those revisions.
you
Yeah,
see
that's
the-
my point. That's my point. That goes back to this old discussion we've been having about, GDP signaling recession. GDP declined in the first quarter, but gross domestic income, which is another way of calculating, the output of the economy from the income side of the economy, looking at personal income, what people are making and corporate profits and adding it all up. It should be conceptually exactly equal to GDP, but they're based on different source data, so they're not exactly the same. And GDI, gross domestic income, grew 1.8% in the first quarter. And that difference between gross domestic income and gross domestic product, that measurement issue, it's called a statistical discrepancy, is the largest it's ever been in the data as a percent of GDP. Yeah, largest ever. So that suggests something is off the mark here, right? And I would proffer, my guess is it's GDP. Back to your point, Claudia, it's inventories and trade and government spending, things that are very difficult to measure, in real time, or at least in a timely way. So my sense is that when we get all of the data in and all the GDP revisions, and there's a lot of GDP revisions, we're going to get another annual benchmark revision here I think at the end of this month or next month. I suspect that number is going to get significantly revised. I wouldn't be surprised if it gets completely revised away. The GDI feels a lot more consistent with the reality of what's going on than GDP. Now, that's a good indicator, right? It has a message.
Mhm.
No?
Yeah. Did you also notice in the FOMC minutes from the June meeting, they called out GDI? It's the first time in
No.
a while I've seen them include
missed
GDI
that.
in the minutes. Mhm.
What'd they say?
They were just exactly what you just said. Like, GDP fell, but
Oh.
looking at alternative measures, because now they're gearing up for if another decline in GDP, they can point to GDI.
I thought I
saying
was
we're
saying
not-
something really novel, but you're telling me no.
No, that's a good one to
No,
bring
that's
up.
a good one.
That's I,
I was so bummed. I thought that was a good one.
But I think the truth likely lies between the two.
Yeah, it probably does.
Because
Yeah,
I think GDI is getting overstated by corporate profits, and just the way the BEA calculates corporate profits could be problematic.
well, and the fourth quarter was a monster print.
yeah.
I mean,
Mhm.
it was over 4%. You know, it's like
6% plus. Yeah.
the memory loss is just amazing during this crisis. You know,
Yeah.
like these,
These
anyways.
numbers. Yeah. Hey, let's talk about another debate. I know you have strong views on this too, and this is the inflation debate. You know, obviously inflation is very high, and the question is why? And that's not simply an academic question, because that's critical to understanding where it might be headed and also what can be done about it. You know, what's the appropriate policy response, monetary or fiscal? And you know, the debate is the high inflation we're observing now, 8.6% consumer price inflation through the month of May. We're going to get another read on that next week for the month of June. What's behind that? Do you have a view, Claudia, with regard to that?
Right. And I will underscore your point that it matters, right? Being right for the wrong reason and having then
Totally.
a voice about what now to do or assess can have very bad consequences, right? So, well, to answer your question first, and then I'll back up with
Yeah.
the fill it up. So
By the way, I'm just saying, amen.
yeah.
Amen. Yeah, go
So,
ahead.
To me, with inflation, a lot of the other problems, I mean, COVID is the root of all evil, right? Like we shut a $25 trillion economy down in March of 2020. Much of the global economy was shut down. It turned out, and I mean, I was surprised by this, but in hindsight, shouldn't have, it actually is really hard to turn it back on, right? And so we have had disruptions that have taken a long time to work themselves through. COVID is a supply disruption, right? And it's not just the supply chains, it's, you know, the workers that had to stay home, the daycares closed, people were afraid of dying and didn't want to go back out. There was this shift in the US economy that I, as someone who was point on consumer spending, like I still can't wrap my head around it. People shifted so fast from buying like a lot of services, because that's like most of what the US economy is to buying a lot of goods. Like we just don't have systems that are resilient enough to deal with these like really massive shifts, right? And so it's clear that COVID caused the problems, and it's still causing problems, right?
Right.
And you know, as one example where it really led some people like myself astray in terms of thinking it was going to be more transitory or temporary is last summer around this time we saw, you know, we'd seen a spike in inflation in, you know, or in the spring of 2021. Things were opening up. I mean, it made sense, but, you know, getting back to it, you know, it was going to be inflation. And then in the summer into the early fall, we had inflation month over month stepping down, right? You look at that number, like,
Yep.
again, if we could remember back to last year, like it looked like that was happening. And then Delta came, and then Omicron came, and then Putin came. Like, you know, you had continual shocks, and Delta and Omicron are yet another supply shock, right? Like these waves, and we didn't anticipate them. We weren't prepared for them. So it's clear that that was a big problem. There's really good research. Adam Shapiro at the San Francisco Fed has been like doing all kinds of really interesting work. Actually, San Francisco in general has done just a ton of COVID work. And one of his latest studies is, you know, like half of this, I mean, a big chunk of the inflation is supply driven. A much smaller portion is demand. And then there's kind of this in between that's hard to tell. And so I do think that some of the demand that was put out there, you know, whether it's CARES and rescue plan, all these things, demand also people getting back out, pent up spending, you know, whether you got stimulus checks or not, like that contributed to inflation. I don't think it was the big contributor. I think it was supply. And then the other thing that I don't think we talk enough about is like the two collided with each other, right? Like we gave people a lot of checks, and I know from my own research, and then I was like, oh my God. Well, there was a fair number that uses like down payments to buy a car. Well, it just so happened one of the places that COVID really disrupted was in used cars, So we had demand going straight at some of the hardest hit sectors. And so that, creates problems, but why it's important to have a sense of supply versus demand. And I mean, really, some of the people that push the demand angle, it's all the rescue plan.
Yeah.
They don't even talk about COVID. They don't talk about Putin. It's all is like, if we could just get it's both, it would be a, a real step forward, because the problem is if it's all demand, then it's like the Fed's got this.
Yeah.
And the government
exactly.
should just stop, because they're just going to mess it up. But if it's supply, there's a lot the government could do. It might not fix things right away. But it'll make us more resilient in the future. But if the Fed can't, like if the Fed goes at supply driven inflation, it's not going to end well. So that's why it matters. And that's why I think there should be a two-pronged approach right now.
Yeah, totally agree. I mean, I think that's dead on. I mean, the way I would summarize what you just said, and just to make it clear in my own mind,
Mhm.
is that there's a long list of reasons for high inflation, but at the tippity top of the list are the pandemic and the Russian aggression. And those are two massive supply side shocks. And by the way, evidence of that it's supply, not demand, is that the inflation that we're observing here is everywhere. The European, the EU inflation rate is now equal to the US inflation rate. So that would argue that it's the global supply shock. It's not some idiosyncratic piece of fiscal policy or something else here that's driving demand higher and creating the higher rates of inflation. Is that a fair way to characterize it? A thumbnail way?
Yeah, except if you take out a lot of Europe's, like the measured inflation is food or is energy, right? Their quote unquote core has stepped up less than in the United States. But to me, that like the United States and Europe are not apples to apples
Yeah, well,
comparisons. But yeah, I mean, people are living with high inflation now, and we would have had the gas prices regardless. And honestly, any interview you listen to people talking about inflation, it's gas, it's food, it's housing, right?
Yeah.
Like that's what people get really angry about, because the other stuff, a lot of people can kind of, switch around their spending and cut back or buy the cheaper stuff. But like those, they just got to have. So yeah, we were going to have high inflation. From the fiscal relief, there are a lot of people that have some extra padding, like a little bit of a buffer they wouldn't have had otherwise.
That's it's because since you've focused on fiscal policy and kind of from the behavioral side of the fiscal policy, one thing I find really fascinating is that households did build up a lot of savings during the pandemic. High income households because they sheltered in place, lower middle income households because they got a lot of government support. And there was a great fear that excess saving would find its way into spending and demand would really be strong. And ultimately, the inflationary problems we would have would be demand generated. That has not happened. What has happened, seemingly, is that people are taking that saving, that so-called excess saving, and supplementing their purchasing power. So if you have this higher inflation, it's cutting into people's purchasing power. Their real wages are down. It's an real income shock, but they're not cutting their spending. They're using the savings to supplement and continue to spend at the same rate. They're not spending with abandon. It's not like they're going out and spending like crazy. They're just using that savings just enough to keep their spending at where it would have been otherwise, which I find incredibly interesting and fascinating. Do you think about it the same way? And do you have a sense as to why that's happening?
Yeah, I think for a long time we've misjudged people with lower income, right? Like there's a lot of, people don't save because they're irresponsible, or they're just not even irresponsible, but just like, I need it now. And, that they can't wait. And like rich people, they're patient, they wait. And I've always thought, the problem is these people don't get paid a living wage, right? Like the cost of just getting by is pretty high. And if your income isn't that much, well, guess what? You don't end up with saving. So this is a time where people were able to put some money in the bank. And it's like, gee, look at that. They want a financial
Yeah.
buffer just like the rest of us. So I'm not surprised. And frankly, given how bleak some of the consumer sentiment surveys are, like it makes sense to me that people are using it to supplement the spending that they would normally do as opposed to going out on a shopping spree, because there is some caution. But a recession is demand declining, right? Like to me, the consumers, that money they have set aside could really be what gives us a soft landing or a hard landing.
Exactly. Exactly. Hey, so you've kind of laid out a case for if we want to address this inflation, supply side inflation problem, there's a Fed can only take us so far here, and if they try to take us too far, that's recession. They can't solve a supply side problem without pushing us into recession. That's not good. We don't want that. So we would be nice if we could get Congress and the administration, fiscal policymakers, to kind of kick in here. Do you have any perspectives or views on what they should be doing, what they should be focused on in this regard?
Yeah, so I've had the opportunity, actually it was right after Putin invaded Ukraine, to talk to a large group of members of Congress. And they're asking about how should we tell the narrative. I'm like, don't worry about the narrative right now. You need to do something. But my point is,
Oh, the congressmen were saying, well, how do I frame this?
yeah, I was supposed to help
Yeah.
with the narrative of
Yeah,
like the
right.
rescue plan.
Okay.
And I'm like, I think the rescue plan was great. I was just talking about how I think it's
Yeah.
disheartening, but I said, not now. Like
Yeah.
people are about, what have you done for me lately? Right. Like, and we have a problem right now. You got to get it to the finish line. And one of the things I said, in large part because the Fed can't do this, I was like, you need to move heaven and earth to get gas prices down. Relative to before COVID, gas prices have doubled. I mean, when they're at the $5, they've doubled. Since March, they had increased $1.50, right? Like nobody can adjust to that kind of change. And the Fed can't get those prices down. Like there's so much thinking in DC outside of the Fed's got this. They got it with inflation. Every time I hear that, I just like, I seize up, right? Like that's just, it's not true. And the things that people are really getting hurt with, like gas, Fed cannot fix that. So there are limited things that the administration can do. There are a lot more things that Congress can do. But at the end of the day, it's not about yelling at oil and gas companies like on Twitter. You have to either increase supply or decrease demand. Like there's no getting around this, right? And there are ways to increase supply. Skanda Armanath, who's at Employ America, has had this, proposal and, talked, to policymakers about basically writing contracts for refilling the Strategic Petroleum Reserve, like kind of guaranteeing a base the price to refill, because 1 year of high profits is not enough to get shareholders to give a green light on making capital investments that are going to be years into the future, right? Like they've got burned on this before. Like nobody cared about them in 2020 when the bottom fell out. Nobody cared about them when OPEC came after the fracking industry, 5 years ago. Anyway, so that's just one idea that within the administration they could pursue. The thing that Congress should be doing right now, and doing very publicly, because it would help, I think, even knowing it's in train, is writing energy legislation, right? With other things they should be putting in the legislation that are long-term investments, but something that really spells out the path forward with the fossil fuel industry. Like this is not going away, right? You should train it down, and the buildup of the renewables. Even just giving clarity could have some short-term effect. But the thing is we cycle with these energy prices like every 6 years or so. This will come again. Like we can't be this dependent on global oil markets and on dictators around the world, right? So I think that's one where we ought to be using a crisis to fix a very structural problem, and they ought to be doing whatever they can, right? Get supplies up, tell people to have the federal government work from home. Like there are things they can do, but they're not.
They're hard. Yeah, to get
and-
done. Yeah.
And they're just
Politically. Yeah.
waiting. They're waiting for the supply to fix itself. And we've seen some progress. And honestly, that's given the inaction with Congress and administration, we're banking on the supply problems from COVID to unwind and unwind fast enough before the Fed gets too trigger happy with their rate increases.
I apologize for my, everyone who listens to this podcast knows my dog. He's 17 years old and is just losing his mind. So we make do. So we all make do. But I hear you on the energy. I mean, there's nothing that drives people crazier, makes them more down than having to pay $5 for a gallon of regular unleaded. I mean, that's just too much to bear. And I think that's, in my view, the key threat to the economy and continued expansion. I mean, it's not going to take a lot. I mean, a Cat 5 hurricane blowing through the Gulf takes out a refinery on the coast because refiners are operating at 100%. Gasoline prices go north of 5. It just feels like we're going in. It's going to be pretty tough to avoid. So I think you're absolutely right. That's got to be number one priority. We are running out of time. And the way we've been ending this podcast recently, just given that recession is top of mind, is we each give our odds of a recession beginning in the next 12 months, next 24 months. Now, we're forecasters, so we do this for a living. So we're going to do this and talk about it a little bit, but more than welcome to join in this bit of a parlor game if you're so inclined. I'm very curious, what your views are. And I'll start with Ryan. So Ryan, what are your odds of recession over the next 12 and 24 months?
So over the next 12 months, it's 65% because of the Fed.
12 months, 65%.
If they go 75 basis points again, then they're going to break something. So I think if we go into a recession, it's going to be in the next 12 months.
Oh, so 24 months is? That's
coming down because I think if we get through the next 12 months, if we get through and, hopefully the Fed pauses once they hit 2.5%. Like if they pause, we got a better chance of engineering a softish landing. But if they keep going, something's going to break.
Okay. So, Claudia, the reason he goes up to 65% because we have this forecast rule of thumb that if we are going to make a major change to our outlook or major change to any assumption, fiscal policy, monetary policy, whatever it is, we have to have a very strong level of confidence in that change. And it has to be 2/3 probability or more. So he's gone right up.
I'm right up to the line.
He's right up to the line. So because he knows if he said 66, I'm saying, Ryan, are you saying we should put a recession into our baseline most likely scenario? You know what I'm saying? I wonder, let me ask you this before I ask you your odds. When you were doing the macro forecast or contributing to that at the Fed, was there a similar kind of philosophy? What was the thinking around that? Did people, if you wanted to make a major change?
So, I mean, the forecast is the modal outcome, right? It's the most likely. It's
most
not like
likely.
An average. Whatever we write
in the
down
middle
is
of the distribution.
Yeah, it's what we think is the most likely thing to happen. We see the thing is they revise every time we revise every data release, right? So as things come in, the whole forecast doesn't until like you get closer to the FOMC meetings. So the revisions tend to be smallish. There's no like particular rule.
Okay.
But yeah, big ones we talk more about.
It.
Right. Because you got to change the story then.
Yeah. That's the point, right? I mean, like the American Rescue Plan at one point, it looked like it was going to happen, then it didn't look like it was going to happen. And what you assumed about that was massive.
No, those obviously like go in as soon as they're likely. Yeah.
Well, no, for us, it's got to be more than 50%, right? Because if it's 50% or 51% or 52%, you get whipsawed, right? You're going back and forth, right? So that's our level of conviction. But anyway, that's kind of forecast philosophy. Makes sense. So do you want me to give you my probabilities before you give your probabilities?
Sure, go ahead.
What do you think, Ryan? Should I make her go first?
No, I have a feeling I could probably guess her. Probably.
It's going to be like mine, you think?
Yeah.
Okay. I'm very curious. Yeah, you can't change Claudia. You
Yeah,
can't
no,
change your
no,
mind.
don't worry.
Mhm.
Don't
Write it down
worry.
on
I
a
don't
piece
think
of
she would.
paper.
No.
Yeah,
and
I
we're gonna
don't
you're-
bend to peer pressure.
Okay.
And you also don't want to be wrong.
I should have known. I clearly could see that. All right, I'd say 40% probability of recession in the next 12 months, and even odds more or less over the next 24. So very high risk, and that has not changed. At least not in the recent past. That is, obviously uncomfortably high, and goes to my point. If anything else goes wrong, even a small thing, given how dark the pessimism and the mood is, it feels like we're going to go in. So a lot of risk around that. What about you, Claudia?
Yeah, so I had been zipping along with my modal forecast of no recession.
Okay.
Right. So but it was pretty close. I think I had it like, 50% or something. And then had like 30% a mild recession, like a 2001 recession. And I put very small odds. Actually, it must have been like 40%. I put really small odds on the severe recession.
Mhm.
Like I don't think we need a 10% unemployment rate in 1 year to get inflation down. That's not. Last week was rough. Every week feels rough. Because Jay Powell, in the event where there were a bunch like, Lagarde, and there was some like little event with these central bankers, so inflation expectations came up again. And by this point, that increase had revised away. Right. So now it was just a 10th. It was totally in the range historically. Things looked really stable. And then
just to let people know, the University of Michigan survey, which has inflation expectations, it was high when the Fed raised the rate.
Right. And
then it got revised away.
Yeah. So
it short term, 1 year.
Short term. Short term.
Yeah. Short term. No, that was the long term.
Oh, was it the long term?
It was long
Didn't
term.
both get revised? I thought both.
Well,
got
maybe
revised.
the short, but they don't care about that.
Yeah.
Because that's like gas prices. But no, it had been early in the month, the inflation expectations, the preliminary had been went from 3 to 3.3, which again in Fed land is a big increase. And then when they got the final numbers, it went to 3.1. So it only been a 10th. Totally nothing burger. But then in this speech, which now we'd had the final, right? Jay Powell was like, well, inflation expectations are stable, but we need to keep moving because they might become unanchored. And I was like, oh my gosh. So as soon as I saw that, I was like, anyways. And so that was the point where my odds went up above, like maybe like to 60%, something like that. I still think, because
you're in good company.
Yeah, I mean, to your point, like they're going really hard,
Mhm.
right? And they're going to get another bad CPI reading this month. They're going to do 75.
For sure.
Mhm.
And what is so strange to me, actually, it's a little change, in their summary of economic projections. So what the FOMC writes down, each of the participants, they released it before the last meeting, they get to write out their forecast, like if they were chair for the day, and they have like, the appropriate policy under it. And what the typical participant was looking for was like a little over 4% core inflation in the fourth quarter.
Yeah.
Since February, month over month, inflation has been running at like 4%. So it's like, it's this weird, the risks are to the upside, but I'm like, what are you looking for? Like you keep going at it and you basically got what you want at the end of the year. So I'm just a little concerned they're pushing too hard, and it's all gonna kind of start.
How about this for a theory? How about this for a theory though? That is a little more sanguine perspective. Okay. And that is, if I were in his position, I'd do the exact same thing. I'd be talking really tough, because I want to keep absolutely sure that inflation expectations stay anchored. I am not going to let that go. Mm-hmm. And maybe I don't need to raise rates as much as I'm saying, and if I don't, that's great. But if I say that I'm going to do this, and that gets inflation expectations where they are, and it's embedded in financial conditions, the stock market's priced to it, credit spreads are priced to this, tough talk. the value of the dollar is price of this tough talk. And all I have to do is execute and give you what I'm saying I'm going to give you. Financial conditions shouldn't tighten anymore. I should be okay. But I deep down think I don't need to get to 4% funds rate target to get what I want.
But they could pair the tough talk and do 50 basis points. They don't have to do 75. I think it's just, but I hear you, and I absolutely agree with them raising right now. I
Yeah.
would just be raising 50,
Yeah.
not
Well,
75.
I don't mind 75 if it's kind of like, yes, it's 75. I didn't really appreciate or thought it was a tactical error, not strategic, but tactical to kind of do it on the fly, ad lib, 3 days before, put a leak in the Wall Street Journal that just didn't lend confidence. And, we didn't use the economic plane metaphor. I always use that, but they're the pilot at the plane, and they're saying, oh, we better turn the knob this way or we're going to crash. That doesn't make me feel good, that they're doing that. So, but anyway, this is a great conversation and I really appreciate it. And, there are some economists that no matter what they say, I just disagree with. Some economists, no matter what they say, I agree with you. I think you're in the latter, Claudia.
Wow.
And I'm not sure that's good. We're both going to be wrong. We're both going to be wrong. But anyway, I really enjoyed it. And I hope you do come back, even though I butchered your name. Next time I won't do that.
Really, you're good.
All right.
So,
He
all
butchers
right.
everybody's name.
I do indeed. Yeah. Thank you so much. Take care, everybody. Have a nice spot. Have a nice week. We'll talk to you next week. Take care now.